Welcome to PIMCO Pod. In this episode, we discuss how AI-driven capex is widening the gap between opportunity in equities and risk in credit. Stay tuned after the conclusion of the podcast for additional important information. What would the Merton model say about AI capital spending? By Lotfi Karui. Key takeaways. AI-driven spending is benefiting stocks more than bonds. Equity investors are leaning into growth from AI investments, while credit markets are demanding more compensation for rising leverage and uncertainty. Not all credit is equal. Software and private equity-backed borrowers are under more pressure, highlighting the need for careful issuer selection in below-investment-grade portfolios. Senior structured credit remains resilient, for now. High-quality exposures such as AAA-rated collateralized loan obligations, CLOs, continue to hold up, supported by diversification and their position in the capital structure, but would be tested in the unlikely event of a severe downturn. Hyperscalers. Volatility helps the call and hurts the put. 52 years ago, economist and future Nobel laureate Bob Merton published a seminal paper on the valuation of corporate bonds. The Merton model has plenty of shortcomings that the financial literature has spent decades trying to address, but its central intuition is rock solid. Shareholders are long a call on the company's assets, and bondholders are short a put on those same assets. In other words, equity investment centers on upside potential, while credit is about downside mitigation. That single insight explains much of what we are seeing recently across the capital structures of hyperscalers, the massive providers of cloud computing and networking resources essential to the AI build-out. Quarter to date, sentiment toward the tech sector has notably improved in the equity market, with the exception of the weakness late last week, buoyed by a decent first-quarter earnings season that calmed investor nerves over the risk of capex overspending. The relief has been visible across the entire AI ecosystem: semiconductors, hyperscalers, and even software, which had been the laggard for much of the prior quarter. The credit market has shown more restraint. Hyperscalers have underperformed the broader investment-grade market in recent weeks as investors digest the implications of a multi-year debt-funded capex cycle. Software, meanwhile, has yet to catch a bid in the leveraged loan market, where AI disruption risk remains priced in. More on this below. The Merton framework helps explain the bifurcation between equity and credit price moves. A leveraged bet on AI infrastructure with uncertain and potentially volatile payoffs tends to raise the value of the equity call even as it makes the bondholder's implicit put more risky. In Merton terms, asset values may be increased, but so is the strike price of the put. For shareholders, the upside justifies the gamble. For bondholders, the downside is real and the upside belongs to someone else. That wedge, the classic asset substitution problem, is what credit investors are increasingly pricing. And until the re-leveraging impulse shows signs of reaching a plateau, the divergence across the capital structure is likely here to stay. Leveraged loans. The sponsor put is no longer working. The gap between software and non-software leveraged loan performance remains acute, and the pressure is not confined to credit. Despite retracing the entirety of their post-Iran conflict sell-off, software equities have also failed to fully recover, even as the broader equity market continues to touch new highs. Within the software sector, there has also been clear bifurcation between sponsored and non-sponsored issuers. Although private equity, PE ownership/sponsorship, had been viewed favorably during past periods of weakness, such as the COVID-19 pandemic, this is no longer the case. Loans issued by PE portfolio companies have been materially underperforming those issued by non-sponsored firms. Of course, at the index level, one could cite differences in quality and sector composition as the driver of this performance differential, rather than just PE sponsorship. Therefore, to address this critique, we go deeper to show the result in two more robust ways. First, we conduct a like-for-like comparison by focusing on B-rated software loans, S&P, UBS Leveraged Loan Index, constructing one portfolio of sponsored issuers and another of non-sponsored ones. These portfolios control for differences in both credit quality and sector. Even within this tightly controlled subset, PE ownership has been a drag on performance. In the second approach, we use a regression-based framework. This method effectively compares two hypothetical portfolios of sponsored and non-sponsored loans in the same index that are otherwise identical in terms of industry and rating composition. Here again, the result holds, suggesting that the underperformance is not simply a function of compositional differences, but rather reflects a more fundamental shift. The broader implication is that the market appears to have materially reassessed the extent to which PE sponsors can, or will, provide liquidity and funding backstops to their portfolio companies. AAA CLO performance. No spillovers yet from the software sector. While software loans have repriced, the broader leveraged loan market has largely succeeded in isolating this weakness and hasn't been dragged down in a meaningful way. This containment helps explain the striking resilience of spreads in AAA collateralized loan obligations, CLOs. So far this year, AAA CLO spreads have outperformed their historical beta to leveraged loans by a wide margin. If the past empirical relationship had held, the 30 basis points, BPS, of year-to-date widening in leveraged loan spreads should have pulled AAA CLO discount margins wider by roughly 11 basis points. Instead, AAA CLO spreads are actually tighter by 10 basis points. Aside from the index-level containment, another main reason for the AAA CLO outperformance is structural subordination, that is, the order in which claims are contractually repaid, with senior tranches coming before junior ones. Even where software exposure exists within CLO portfolios, the deep subordination cushion at the AAA level means the bar for losses to reach the senior tranche is exceptionally high. AAA attachment points are deeply out of the money, and CLO portfolios tend to be diversified across hundreds of issuers and dozens of sectors. Therefore, for AAA CLO spreads to reprice meaningfully wider, the stress would need to extend well beyond a single sector. It would require a systemic credit event producing default losses far above historical norms. That scenario remains firmly outside the baseline, particularly given the continued resilience of U.S. economic growth. Thank you for listening. That was What Would the Merton Models Say About AI Capital Spending? For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.